So today we'll be talking about understanding financial statements, particularly relevant to the farm business. It's part of a broader webinar series that we're running as part of a regional women's financial wellbeing project over 2015 and 16. So we've run over 20 workshops and a dozen webinars that are all available on the website if you would like to hear more sessions like this, or if you'd like to review parts of this session, you'll be able to access that in a few days' time. So for those of you not as familiar with 10,000 Girl, we're a not-for-profit social enterprise that focuses on improving the financial well-being of women across Australia. Our goal, to explain a bit about our name, is to help 10,000 women become financially empowered, and we've actually surpassed that goal now, and but we keep on keeping on. So, as I said, today we're going to talk about understanding business financial statements, particularly in the ag industry and farming in particular. So, of course, we always, even the best financial manager is always open-minded to how we can better read and analyse and use our management reporting to make better decisions and to have better conversations with our financiers and our accountants and of course, as I said, make better day-to-day business decisions. So we're going to go through the different financial statements and what's the purpose and how can we use them effectively, how can we learn from those statements going forward into the future, what are some of the warning signs, how you can make changes, what's the different perspectives between you know, how your bank manager might look at a financial statement compared to how your accountant might have that discussion with you, and what are some of the best practice sort of learnings that Mark, as a Rabobank rural business manager, sees across his client base. And so we can learn not only from Mark but also from what he sees in the field. So we have everyone on mute, otherwise we'd have a lot of background noise, but please join the discussion. We really want you to make the most of this opportunity. Use the question box on the webinar control panel to ask questions along the way, and we will include any of your ideas and feedback and questions, and we'll involve that in the discussion along the way. So there'll also be some question time at the end. So please, yeah, make the most of being online live. And for those who are listening to the recording, we hope you get a huge amount of value from it. So we're not providing financial advice, and Mark, this disclaimer goes for Mark at Rabobank also, and we really encourage you to seek independent professional advice before making major financial decisions. And we'll talk a bit today about you know, the benefit and the value that your advisors around you can bring to your business as well. So thanks to our generous partners, we've worked with Rabobank now for over 5 years, and we really value this partnership. Obviously, we have a shared passion for making sure learning resources are brought to regional Australia particularly, and so we've run a whole lot, probably near 100 workshops across Australia with Rabobank to date, so that's really exciting. Financial Literacy Australia has provided a grant to run this 2-year regional project, and we've also received support from the Financial Planning Association, from HESTA, which is an industry super fund, from the ATO, which, believe it or not, has a wealth of information that's getting more and more user-friendly on their website. Some really good interactive tools and stuff they've been launching recently. The Understand Insurance is a consumer site run by the Insurance Council of Australia, another good resource to review and answer any questions around general insurances, and Credit Savvy, which you can get your credit score and understand a bit about some of the recent changes in the consumer credit laws. So thank you to these partners, and thank you especially to our guest today. I'll let you introduce yourself, Mark, and obviously I've given Rabobank a wrap because I am genuinely impressed by every single branch that I've visited over the last few years, and all of your sort of genuine commitment to the long-term sustainability of agriculture. So we look forward to your presentation, and thank you, Mark, for joining us today.
Thank you, Zoe, and excuse me. Thank you, Zoe, for inviting me along. It's really appreciate the invite to give this presentation. In regard to the presentation, I've been doing these for a little while, but probably just more not on a national scale like this, but more on a local scale. There's an agriculture university in town which I've been involved with in doing exactly this, understanding financial statements, and also some local farm groups that have been going through some tough times in the last sort of 5 years, and sort of saying, okay, what actually do banks require? So my whole presentation is really focused on the ag side, but it's also what do I do on a daily basis when I'm looking at someone's business. From my background, I went to uni here in Orange at University of Sydney, and then from there my first job offer has been with Rabobank, and I've been with Rabobank for 15 years now. So I've worked throughout New South Wales and Sydney and Victoria, and now based in Orange for the last 10 years. So just to a bit more background from myself, so not only bank manager, we are involved in a family farm at Coolar, and then my wife and I run a business in town. So it's actually good to personally to get this, to have this understanding, because we can then apply it in our own farm business, and then in our own business also here in Orange. So to we're now up to the content section. So just to have a look at that, we're just a quick going over of what actual financial statements are. What do they actually tell us? So again, it's all about the bankers. This is the banker's opinion. The ratios we look at, so how do we complete financial analysis? So the types of ratios. I've also got a section in there. It's not ratios that we actually use, but something that could be good for people for benchmarking. If they do have a business outside of farming, it could be worthwhile to look at those. Some tips, so really sort of some of the things that what I've found over time that really works well in businesses. And then if we do have some time, there is a bit more stuff about what the actual, so being a banker is not just about analysing figures, it's also about analysing people, looking at structures, identifying risks. So if we have time, we can go through that. If we don't have time, it can always be, we can always just discuss that at a later date. And then if anyone's got any questions, and just a bit of a summary. So just on the next page, whenever I approach a business or even personally in our family farm, I always like to know before probably looking at any of the financials, looking at assets and liability, any of that, I looked really what is the short-term goal? Yeah, basically what's the funding requirement, but how does this fit into the long-term goal of the business? That's probably my first thing that I look at. Now with that, it could be, so start with the end in mind. What do you need, and how does a business generate that? Simply probably looking at a classic case of a farming business. If there's a farming business, there's mum and dad, and then the sons and the daughters come home, and potentially we could have 3 families on the farm. all of a sudden we could be looking in the order of $100,000 worth of drawings. Do we look at that and say, okay, can that business sustain that? So there maybe needs to be an adjustment. I mean, that's definitely sort of the immediate goal of the family, that we need to cover the drawings. And then we could look at, say, what are the end goals? Is the end goal to reduce debt, build assets, educate kids, retirement, lifestyle, those sorts of things? So that's always my first focus point. Now, to get to the financial statements, now these parts that I've got here are really just for our customers. With business customers, there's a few more things that lenders would want. I don't know that side of the business, as I've only ever worked for Robank, so I don't understand how the commercial side goes. But certainly for an ag, this is what we look at. And ag lending is a combination of assets and cash flow. So the serviceability side of the business. Financial statements just are not just the statements you get from the accountant. It is it's that plus assets and liabilities. So what assets and liabilities are in the business, and a cash flow budget. We normally get these for 3 years, so we can get a true representation of the business. And the idea of the day is just look at, say, how all these things fit together, and what does a bank look at, and certainly what we look at is what every business should be looking at. So it allows us to complete our due diligence, find out how much the cash the business can generate, and what then happens to the cash. So if we just move on to the next slide. So the first item, or first part of it, is the trading accounts. Now, sometimes accountants actually don't forward these to us. These are a crucial part of the financial statements that we require. To look at these, they show how the business is traded. So what has been bought and sold. And again, it's this is for a livestock operation. If we just keep on going a little bit further with that, Zoe. So we can see here what the opening stock is. So accountants, well, certainly my accountant is always wanting updates of numbers and those sorts of things, so we can get a true representation on the trading accounts. Because accountants, generally speaking, this is all for financial basis, not for the cash base, and profit in this simple case is just, for us, sales minus cost of sales. But with accountants, it's the opening stock plus purchases minus the closing stock. I'll go in a little bit more detail in a moment, but just probably the trading account gives us some information. The type of operation. Is it a breeding operation? Is it a trading operation? Allows us to show movements in stock numbers. What I'm saying there, if we're looking at some financial statements and there's not a great deal of profit out of the livestock operation, we can have a look and say, well, actually, they're building up numbers. So we can see that although they've lost some income, there's not the profit out of the livestock enterprise this year, there'll be more profit out of it next year. On the other side, if all of a sudden we have a big profit and the stock have been sold down, the bank would have some concerns about, well, if the stock have been sold, how do we generate income the next 2, 3, 5 years? So it's an indication for us of how a business can, or what's happening in the business. In this particular example, we can just see that there's been a sell down of stock of 194 head. It allows us, for budgeting purposes, to see that historically, or in this particular year, the average dollars per sheep, or per steer or whatever, gives us, for budgeting purposes. Also allows us to have a look at land percentages, and the other thing is excessive stock losses. So that's why there's a section in there for deaths. So that does give us, it gives us a snapshot of what's been happening in business, and if we layer that over year upon year, it can give us a really good general indication of where the business is going. Next slide, please. So how the trading accounts differ and the focus is that, as I just mentioned before, the banks need to find the cash because the accountant has completed these trading accounts for tax purposes only. So if we look at this particular case where we've got 700, where the gross profit from the accountant is almost $47,000, but from a cash position or net trading, you can see that, which is the sales minus purchases, it's nearly $49,000. So that can just show you the difference. Although it's not a great deal here, it can still. This is the things that we just need to look at, and everyone should look at these sorts of things. Next slide, please.
That's an important part, isn't it, Mark? That this is not just from the bank's perspective. This is from a business manager's perspective, isn't it? That
Correct. Yes, definitely. So, yeah, I mean, I don't. I mean, they're crucial for us to get these, but it's having an understanding, because you can get wrapped up and say that the profit out of the business or the gross proceeds were $900,000, but again, we just need to understand what cash has been generated behind, and what sort of stocks have been purchased also. So, but they're definitely from our point of view, and I think I think if it's good for a bank to know, well, I think it's even more important for the individual and the business to know how to interpret these. And it could certainly be that I don't know, say one person in the business is doing the books, another person says, well, let's make it aware to everyone, and we say, look, this is how we interpret. This is what we can see is happening in the from these trading accounts. Certainly. Now, so how we differ from in the focus. So you can see in this particular slide where we've got sales of 25, we've got purchases of $100,000. Even though the accountant is showing a gross profit of $7,000, the net cash position is $85,000, a deficit of $85,000. So that's probably an extreme you can see, but it actually does happen quite a bit.
Oh, and so how often do you get your financial statements back from the accountant and go, that's not what it looks like in my bank account?
Exactly. So yeah, it's all so this is, if you have an understanding of how they're formulated, then you can apply it to your business. I mean, probably I know for our business, we probably always have a look at once the financial statements come out from the accountant. We say we can look at what we did on our cash book figures and see how relevant they are. So that's probably just a guide for us. So that trading account then actually flows in. So if you can see, just profit from trading, that flows in directly from the trading accounts. So it'll show. Now, this is essentially what allows us to see if a business is profitable or not profitable. There are some tricks. I mean, it's produced in a defined period, so just be careful in that especially with cropping, that if you're a winter cropper, that the expenses incurred this year are actually for next year's crop. So just be mindful of those, and that's what we will investigate too. So if there has been, last year there was 1,000 acres of crop put in, and this year's 2,000 acres of crop, well, obviously the expenses will be up. So that's those discussions you need to have if you're presenting something to a bank manager. Simply say to them, this is the reason why expenses have gone up, or those sorts of things. So now, so the profit and loss will show the income and expenses over that particular year, but it can include non-cash items such as depreciation, and it could be simply, and one thing I do look quite a bit for is internal transactions between other entity. Simply could be a rental paid to a trust, or mum and dad, or some internal wages, those sorts of things. So it won't include capital items like buying a new tractor, or drawings, those sorts of things. Next page. So again, looking at this one, we've got the accountant's position, so it's a net profit before tax, and then some common income adjustments. So we're again looking for the livestock trading accounts, looking at internal rents, profit and loss on sale of assets. If a tractor, probably a typical example is a tractor is traded in, and if the tractor was depreciated down to to zero, and that tractor's then traded at $40,000. It doesn't mean it's an income for the business, but it will show up on your statements that there was potentially a $40,000 profit, even though the cash wasn't in. So that's things like that we look at. Some expense adjustments, so looking at depreciation, again, internal rents, related party expenses, those sorts of things. And then what we want to do is just adjust those out so we can actually find the true cash profit, cash surplus or cash profit of the business. So if we look to, can we have the next slide? Probably to really highlight this, we can see that a reconciliation for this is if we look at the accountant's position, they're showing a tax position of $13,000, and essentially that's what you pay tax on, is that $13,000. But when we add back things like depreciation, internal rents, there was a differential of about $2,000 in that trading account, less the cattle trading account. Essentially, you can see that in this particular instance, there was $180,000 operating profit, but even though the profit and loss of the financial statement only showed 13 grand. So again, it's us pulling those things out. I mean, a classic case I do also see is deferred cattle sales or sheep sales due to drought. So again, they're not a cash item in the business, so it's pulling those out. So just to make it aware, because there's certainly you could actually come up with quite a big loss there, but it was actually just due to non-cash factors. So the business is still profitable, but it's just showing a loss which is due to a non-cash item. Next slide, please. So once we've got the trading account, we then have the profit, which then flows into the profit and loss. We then look to the balance sheet. Banks are all about looking at the flow of the cash, or if there is a deficit in the business, how is that funded? So now this shows the assets and liabilities of the business of this particular entity. So if there is another old entity that was in use, those unless they're transferred into this new entity, they won't show up. Or if property was purchased another entity, again they won't appear here. This is just a balance sheet of assets and liabilities for this particular business. The assets are shown at cost, so they're not market value. And as I said, the profit and loss flows into this. To looking at those arrows, we can basically, for us to look at this, would say, okay, what sort of changes are here? There's, the cash generated, has it flown into a cash deposit, or has it flown into more stock on hand? Has some machinery been purchased? So to look at say property, plant and equipment, we can see that's pretty flat. So that difference between the 840 grand in 2006 and the 822, I would think would just be the reduction there just purely due to depreciation. On the current liability side, where the liabilities have increased, well then we can say in this instance that they're obviously they've taken on more liabilities from either a bank, a loan, family, or whatever the case may be. So it gives us a snapshot of trends in the business. Now, just to confirm, this is not a current position, or what we normally call assets and liabilities. But I'll talk about that in a bit further. But this is just purely a balance sheet generated by the accountant. Next slide, please. So once we've got those three items from the accountants, there's then the next portion, or the next statement is looking at the cash flow budget. Now, to generate a cash flow budget, probably look at historic figures and then sort of replicate them across. The beauty of a cash flow is that generating it allows you to accurately estimate what the working capital requirements of the business are. It visualises. I mean, I'm a very visual person, so it's good for me that I can actually see that, oh, we're actually going to have an issue this time of year, or no, we're having a great year. It allows us whether we can use those funds for an off-farm investment, more of an asset purchase, a great holiday, whatever the case may be. But at least this sort of gives you a visualisation of what's happening in the business. From a banker's point of view, it will save you, it could save clients time, and also allows everyone in the business to sort of, if there is an issue coming up, they can plan for them rather than sort of at the death door and saying, okay, we need some money tomorrow. It allows you to plan that period. Some things to look at is probably just whenever you're doing cash flows, is probably err on the side of caution. If you can look at the worst, if you can cover it using the worst case scenario, and then if there's some upside, well, that's great. That's perfect for the business. But probably just err on the side of caution and yeah, average yields. Use some long-term average prices. Whenever there's spikes in the market, probably at cattle at the moment, I will probably still use long-term average prices because if we base it on some of those values, we will ensure that we will get through. Yeah, as I said, using previous year's cash book figures, factoring in outside business costs, drawings, school fees, any debt repayments that need to happen. And set cash balances from what you've got on hand, and you can actually see. I mean, you'll see on the next slide in a moment where that sort of where you can see, so you can work out your peak debt from a family point of view. They communicate. Everyone knows where things are up to, rather than saying, "Oh, geez, all of a sudden we haven't got any money in the account." Everyone's aware, and also then the family environment is good like that, and then also it demonstrates to the bank manager your understanding of the business. So next slide, please.
Also, like your cash flow budget can provide huge peace of mind as an extension of that, can't it? And like the exercise of thinking through it and potentially playing with some different scenarios can help
Definitely.
you be really prepared in, a good, bad, or excellent year. You can be mentally prepared if you've sort of thought through the different scenarios.
Definitely, and probably the other thing is too is when families want to make an acquisition, a farm, investment property, whatever the case may be, to look at where the income generated from that farm, but also the downturn, like it'll take, usually when extra assets are acquired, they actually take some time to get up to speed. So what capital is involved or what debt's needed to get that asset up and running. So all very important. I think the communication between the family is probably the key of the cash flow, and that everyone's aware. But certainly, sorry.
We had a great session with Kim Lee from Rabobank. If anyone's interested in some more information about succession planning, that recorded session is on the website, and it just all came back to communication. So if some of these tools can be used to aid those conversations, it's very valuable.
Look, yeah, they're a great planning tool. And it could be that you go through this process and then realise, well, no, it's not the right thing for the business or the right thing for the family. So not only are they, and they're good to revisit too. It's not just, and I probably, I do see that of my clients, the ones that keep on revisiting the cash flows are able to make quicker decisions, jump on opportunities, or get a bit more, they come and see us a lot quicker, and so they're not pushed at that time when they actually do need extra money or whatever that may be. So they're a great tool.
Great.
So a monthly cash flow, it allows you to fine tune. So it's a living document, always revisit it. And it allows, from our side of things, also looks at is there any permanent issues in the cash flow? Is there something that can be analysed, or and probably and also looking at and what's the lowest the lowest point, or what's the peak debt of the business going to be? Those are all good things to look at. So there's from the cash flow. Just on the next slide. Oh yeah, so at that point, you can just see that the peak debt in this business will be just a bit over 100 grand. Just some quick differences between budgeting, just for budgeting, and to look at these things, the financial statements that are issued versus the cash flow that you have. The profit and loss statement from the accountant will include non-cash items, where your cash flow will be cash items only, what's in and out of your account. We've discussed trading accounts. With profit and loss, there's no capital items. With a cash flow, you will have capital items, whether it's a ute or a tractor or a plough or whatever the case may be. The profit and loss will include interest only, will not include lease payments, hire purchase payments, debt reductions, those sorts of things. And then the profit and loss is operational only. It will not include drawings and school fees and those sorts of things. So just be mindful of those couple items between those two statements. Next slide. So in the, from the expended. So just with the cash flows, generating them, whether it's a variable or sort of direct cost, so whether it's numbers shown. I mean, I do physically go through these, particularly when someone's buying an asset. So if they're actually doubling the size of their farm, although the current expense items in that business are relevant, we are now moving up. So obviously we need to say, okay, we believe a number of shorn is going to cost this much, number of drench is going to cost this much. So just bear in mind the variable component, sort of hectares planted, and then fixed items generally won't be impacted by the amount produced. But you need to accommodate. Do you need some more plant and equipment in that next property administration side? And then the non-operational things as interest, loan repayments, and really relevant, and probably on the timing side, probably they're on the side of caution there again too, because sometimes stock or crop could be delayed. So probably have those income items a little bit further out. So worst case scenario, and then your expense items have them as a worst case scenario that they're incurred earlier than what you thought. So still gives you enough buffer of liquidity or cash to cover payments in the meantime. On the next slide, please. So the assets. So the last part of the statement is the assets and liabilities. So it shows a snapshot of the business. Shows the equity in the business. Now with the equity in the business, ideally for a rural business, ideally be to aim for sort of around that 70% or higher equity in the business. It gives the bank an indication of the strength of the business. So the ability to weather poor seasons. So that the higher the equity, the greater the ability of the business to absorb things like drought. It gives the banker or the family an indication of what the asset mix is of the business. So what sort of current assets available? Is it cash, term deposits, stock? I mean, probably a nice way of being. Probably a quick tick for me is if there's a level of debt, but there's things like stock, plant and equipment, or shares that covers that debt, so there's no need to impact on the farm. I mean, obviously the income ability of the business will be downgraded, but those items can be sold and the debt cleared if something was to happen really bad in the business. The other thing it also does, which I find, and it's probably I do see this in businesses, that they track their assets and liabilities, and it shows people how they have accumulated assets over time. I've seen them, showing from this is what I did 10 years ago or 20 years ago when they bought the asset. So all really positive in that regard. Next slide, please. So all of this financial statement, so it allows a banker or I suppose even for family meetings, it allows us to complete financial analysis. So we're past history. So the recent profit and loss balance sheets. So it's great for looking back as a guide for going forward. Shows trends in management, good and bad. As we discussed before, just a snapshot of the business. What sort of equity, what sort of current assets, those sorts of things. How's the debt going to be serviced? How it gives and then it allows some of this stuff gives us some allows us to do ratio analysis. So 3 to 4 years. I mean, from a bank's point of view, we look at just the last 3 years, but could be worthwhile going back further to establish some trends. Next slide, please. So these these first two slides I'm just really centered around agriculture. The third slide I'll go to in a minute, but it's more around commercial. I don't have a great deal to do with that, but certainly I think they're still relevant if certainly from a benchmarking point of view that the family can sit around the table and say this is where this is what we can look at some ratios. How do we let's keep on growing the business. So first ratio we look at there's equity. It's been quite simple there to see that total assets minus total liabilities minus total assets divided by total assets. So again, I will have a page there which shows some ratings, or not ratings, but in a table. So we can look at that. So the loan security is another ratio we look at. The general expenditure income is another ratio we look at. So if anyone's got any queries or would like me to go through them, I can certainly go through them one-on-one. But they're sort of the main some financial ratios. If we just go to the next slide, please.
So in the workshops that we've run, not in the last year or so, but we ran a series a couple of years ago that we went into a bit more depth about financial ratios. People were really interested in not only, so that's obviously what the bank looks like, but how they can use that from a management perspective, like sort of when, why, how they would look at that in a way. So give people context. Yeah.
So look, just on that, I think it's always. I mean, fortunately, our systems that we input the financials in generate a lot of this, so we can actually see from year to year how they're tracking. Perfect, I think, for a family business to do exactly the same thing. To keep on looking at the equity in the business. I mean, the loan security ratio is very much for the bank, but saying that, it can give you an indication of can we move on an asset, or should we, or do we need to provide more security? It probably gives a talking point within the family to discuss that. So yeah, all very relevant, not just for the bank, but for families to use these ratios and track them over time to see how the business is going forward, or going backwards.
With the first couple, it's to do a little bit with people's risk profiles as well when it's multi-generational, and some people want to consolidate, some people want to grow, so they're good conversation points, would you say?
Definitely. Look, this is one part of it. The serviceability is another part, but certainly I do quite commonly hear that that first part is, say I've got this much equity. Well, then the next part I look at, well, that's positive, that's great. Now how are we going to, if we want to grow, how are we going to pay that debt off? So, but certainly from if the equity was quite low, well, then you would really look at it and say, well, to the family, we need to consolidate our position. Not so much to if we want to buy another asset, but it's more if there is a drought or there's a hail event or a death in the family, a higher equity will give you ability to give you time effectively to go on to the next project, tidy up the family affairs, or whatever the case may be.
Great.
So, sorry?
Great, thank you.
So the next part's are serviceability ratios, which are an important component, I think probably the most important component, because the bank, as much as, I mean, the bank over time would like the debt repaid, but probably the biggest thing is the bank wants the interest met. So we need to determine, and this is all about the bank doing due diligence, but it's also, I mean, the family should be doing the due diligence to start with, and that's where all those statements come together and everyone sits around and discusses the proposal, whatever the case, whatever the proposal may be, and then to work out, okay, we think we can make this acquisition, and then we can look to okay, so from a bank's point of view, these are the ratios that okay, we can step outside a little bit, but we would want these ratios, and in the next slide we can see some of the, or sorry, 2 slides time, we can see how they fit in together. But so the interest cover is essentially, so we've got profit. So let's just say there's whatever, it's $100,000 worth of profit, and the interest bill's 50 grand. Well, then we know that the profit generated by the business will cover the interest twice. So that's perfect, right? That's perfect for us. The next one down, the finance costs percentage of income. Again, say if the business, the expenses of the the income of the business is $1 million, and the interest bill is 100 grand. Well, then we know it's 10%. So the other thing you look at is even, not that I've got it here, but the other one, it's a little bit rubbery in that some people can operate businesses quite very frugally, and some people have a bit more expenses involved in the business. So the income to expense ratio. So whenever there's an income made, say $1 million of income, if we say a business costs 60%, so 60 cents on the dollar to produce that, then they've got 20 cents on the dollar of interest costs. Well, then effectively they've got 20 cents on the dollar to live off. So that's why we sort of look at those percentages too, to analyse where the business, essentially it's just benchmarking the business of what it costs to produce and how much cash got left over. So the debt to income is a one that we do use. It's a quick one to look at. If a business has $1 million worth of turnover, it's got $2 million worth of debt. It's just a quick one that I look at, but I do delve in a bit more than that, because as I said before, some people are actually quite can produce income quite cheaply. Some people there's more expenses in their business, so that can throw that out. So, but yeah, this is certainly the serviceability ratios are the big part that we look at. And again, everyone, we track this year to year. Again, families can actually look at these sort of ratios too and see how we're tracking. So again, another one to do some ratios to incorporate into some business meetings. Next slide. So this is benchmarks that would be good for a business. It's not something that the bank uses, but certainly something that you should, if you want to have meetings and points of discussion in a meeting, these could be something. I mean, the debting aging ratio is probably more a commercial business than, say, a rural business. But certainly, the more information a business has, I think the better it will be to make an informed decision. Just on the next slide. This is the financial performance indicator summary I was talking about. So none of this is looked in isolation. It's all, I mean, perfect if it's all sitting on the right-hand side, like the equities are greater than 85% and loan security ratio is less than 50. Perfect, but sometimes the equity might be strong, but the loan security may be low, or the interest cover is not there because of a certain drought event or something's happened in the business. So none of these ratios give us so they're not looked in isolation, but together they'll give us an indication of the strength of the business. And the strength of business also allows us to gauge if there is something happens in the business, what it can do, or it has the ability to draw down assets to get back into play effectively. So some tips. So once you're looking at understanding, so once you look at all these financial statements, it allows you to explain to your financiers, family, what good or bad. Tells them about yield, what extra stocked, or there's machinery needs to be purchased, a reason why the machinery needs to be purchased, or there's been a blowout. All of a sudden, there are repairs and maintenance. So these sorts of things, from year to year, I'll then actually effectively put in a side by side, and then I can run a ruler over and go. I can ask questions. The repairs and maintenance in the 15 financial year was significantly higher than the rest. That was a blown engine on a tractor. So that's a non-recurring expense, because you would hope that's not going to happen each year. So those sorts of things need to be looked at. With the spending time, develop a plan for the future. So I was going back to those goals that I discussed. Getting the right people around you. Accountants, getting the right accountants, solicitors, consultants, of course bankers, you need a great banker around you. But getting those right people could even be a mentor somewhere. Anything that getting the right people around you and getting information, how do they operate in their business? Farmers are as good as opportunity for anyone to just see who's around the area, who's a good farmer, who runs their business well. I'm sure they'll be happy to discuss not so much, I reckon, their business, but certainly how they operate their business, some of the things that they do to make the business stronger. I've
And
found
Mark,
that.
also,
Sorry.
it's not only having the right people around you, it's also utilizing them. So in the workshops and stuff, we've talked to a lot of people and they didn't realize that they could, sit down with their bank manager and ask for some of those benchmark ratios and get some help with their cash flow, and get a good template or, so
Yes.
it's asking questions and really maximizing those people around you, not just having, the best accountant in town.
Yes, definitely. And look, I mean, for myself, probably the best people for certainly for our farm business and for the business that we operate is probably the other farmers, knowing how they operate. Certainly, solicitors are good in the legal side. The accountants are very much on the. I mean, there's like anything, I suppose. There's bankers and there's bankers, and there's accountants and there's accountants. But I think it's the accountants are very good, and obviously the tax planning. So I find that the farmers is where I garnish a lot of information, and they're quite happy. I mean, I will ask them, how will that suit with my business? What are your thoughts? I've even asked them to have, if they're going past, to pop in and have a look and see what they thought about what we're doing. So those things are certainly worthwhile. It's not just using those particular three there. It's using anyone you can think of, even someone outside of farming altogether that's running a business. Recently, I've been talking to an accountant about he got talking to a farmer, and he's actually using a lot of the what the farmer's doing in his business for his actually a lot of his commercial clients. But just he was looking at things a little bit differently and understanding how he understands some of the I mean, probably the next thing was what this farmer knew about his business, the capacity, what sort of costs are involved, what sort of yields he could look at, the profits. And he could straight away replicate. He could just say, okay, this is what my marketing percentage of my lambs. This is what the profit margin is. Those sorts of things and I mean, allows you to make a quicker decision again too. So so the next to go on from there is keep good records, which I will talk about a little bit more after when we get a bit further down. Continuous flow of information to everyone, bankers, family, things like that. If you see an issue in the business or see an issue in the cash flows, be proactive rather than reactive. I do see a little bit of this is the having unfortunately, I think when people become more and more aware of the financial, just having capital or debt invested in non-productive assets, focusing on efficiencies. So not just, okay, if we expand our business, will we be making more money? Maybe look at internally and think of that business, can we generate more out of it? Because I mean, you've already got that business, you've already got that farm. So how much can the property layout or machinery usage or productivity improvements? Benchmark. If a family can get involved in a benchmarking group, fortunately, I have the ability that I'm seeing a lot of these benchmarks because I'm seeing different clients. But I would find, I mean, that is great information for us to use in our business. So I can only think that if you can get in and benchmark against other businesses, doesn't need to be a cropper against a cropper. Could be a cropper to someone involved in lamb production or wool production. It's probably just looking at the business principles. So comparing against other businesses. Next slide. So just when we were discussing this previously, I thought this was good just to this is just my personal opinion of what I think with some of the better operators I'm seeing. They think independently and different. They're always challenging the way they do things, challenging me, and I mean I quite enjoy that. We'll challenge each other in that regard. Taking a business-like approach to the decision making. Having a plan. Don't worry about I have seen over time fads that may, or looking for silver bullets. I think a farm business is very much about trying to make a 1% here and a 1% there, and hopefully over time, you can actually sort of get to either a 10% or 10-15% increase in income, or 10-15% decrease in expenses. That's probably where I see farming is, rather than actually the silver bullet to double production or those sorts of things. Always seeking new information, attending field days and trying to just get a couple of things out of it that can you apply to your business. Simple things, productivity, reproduction rates, reducing mortality, turn-off weight, those sorts of things, and just focusing on what you can control. On the side of managing operating expenses, it is hard to be mindful of not focusing too much on some of the expenses are required to actually keep production up in the business. So, just targeting those expenses. Clear labour efficiency. It's a hard one, but it's always looking, how can I do that? And maybe it's just talking to someone else on how they approach it, and focusing on scale. But don't always look for where you can have internal efficiencies on what you've got currently. To the next slide. So good management. I've always find that the best that have 3 consistent features. They understand their profit drivers, they monitor their business, and they understand the marketing. Essentially, this is the one I've got here, simply about just a beef program or sheep program, but also in grain. Looking where there are lulls in the market, looking at efficiencies on the farm. What are the directions of the business? What are they based on? What's the most profitable? Budgeting on enterprise mixes. Should we move from, should we reduce cattle numbers, move more to sheep numbers, or move to more grain? So a lot of this budgeting will allow you, and once they're set up, they actually don't take a great deal to change. And then allows you to make a quicker decision on an enterprise. The grass investment in good nutrients. In keeping high quality pasture, enterprise mixes, what works complementary, what works best. The timing is crucial. I find that everyone that gets the timing right does show at the back end with their profit and loss. The other things I won't go too much into, but obviously the animal health. It is being a good manager of those assets. Next page. So I don't know if we want to. If you want to stop here, because this is sort of I'm mindful of time. If we do, what are your thoughts, Zoe? There's a few other things I did want to discuss, probably more relevant, pulling it back to just understanding financial statements, the purpose of the statement, those sorts of things.
Yeah, sure. So we can go to jump to the slides that you want to make a priority. If anyone online has any questions along the way, and they can be just whatever's on top of your mind, use this opportunity, pop them in the question box, and so we can use this last 5 or 10 minutes to make sure we're covering information that's really key for you. Otherwise, Mark, share. Let's keep going until those questions come through.
Yeah. Okay. So what? So just on, I might just stop just on. We won't move it on this slide anymore. If we got time, we'll go back to it. It's probably more looking at the purpose. Getting back to the webinar and what it stated. The purpose of each statement. So I think we've covered above. It's more about finding out what is the cash position, what is the asset position of the business. Essentially,
Sorry.
No, that just stop there. That's fine. We don't need to move forward with the slides at this stage. I'll just have a bit of a discussion and then see how we go for time.
Yeah, sure. Great.
So the statements, what they tell you about your current financial situation is what the asset mix, what sort of cash you got available. Put them all together to determine the strength or the weakness of the business. Do you need to consolidate, or are you in your ability to expand? what can you learn from the statements is, from historic statements, it gives you a basis or a starting point, of the business. For me, it actually allows me to visualize the business. What sort of profit the business has been making, or if the business has been making losses, why they've been making losses. It allows you to visualize the business. Great for benchmarking use. And you can pinpoint items to focus on. Is there a debt issue? Is there, wages are too high, or is wages needed? Repairs and maintenance, those sorts of things. So again, it's just visualizing what's in the statements. There was a section in there, what's the warning signs of in a business, how can you make changes? So warning signs essentially is, have there been excesses on the account? Is there a blowout in payment terms? Is there another one to look at, which I have seen a little bit of, is there increasing debt with an increasing asset? What's the reason behind that? Simply could be paying out some family members out of the business, but it could simply be that the business isn't making enough money to support the family. A strategy to stay on top of statements, each to their own and how they fit it in. I mean, probably I would think the more frequency, the better it would be. But saying that's up to everyone's, everyone needs to fit that in. Probably either a weekly or monthly, or whether it's in the first thing in the morning or last thing at night. It's probably a good way to go to sleep, really, to have a look at, to do some payments and things like that. Probably what I'm finding more recently is some of the new software packages out that do make life a lot easier, that they actually get feeds from the banks, so they can actually see what the income and expenses coming out of the bank. So from a time factor, are much better, and actually pick everything up too. Simply for us, I was just using an old Excel spreadsheets, and now we've moved to a new software. I'm just finding that the time that it gives me is huge, and I think it's doing a better job, but it's also giving me more information of where bank accounts are sitting at. Information needed, create statements, obviously, receipts, invoices. Software package was a good way to create those statements, and using historic figures in those statements. And once it's in software, or you have that ability in some sort of package, it will make generating the statements not only for the accountant but for the family a lot quicker. For budgeting purposes, probably good is either use historic figures, or the other one is, if you're venturing in looking at a new proposal, is some budgets online from a local department of ag, or all those types of entities, with determining assets and liabilities, where obviously shares, as you can pull from the share market, but property is probably just, even if you're not aware of the current market, knocking on an agent's door and saying, what do you think, where do you think the property's sitting these days? Has it increased? Has it decreased? So, always looking at the past is always a good indication of looking into the future performance. So, is there any questions have come up?
No, there's a quiet audience today. Oh,
wow.
No, one's come through. One's come through. So, someone said, with regards to assets, in particular where Mark mentioned some primary producers tracked all assets acquired over the years. In your opinion, how is it best to keep and record this over the years?
Sorry, you just broke up in the last bit. Was it, can you mention say that again, sorry?
So with regard to assets, in particular where you mentioned some primary producers tracked, all their different assets acquired over the years, in your opinion, yes, how is it best to keep and record this over time?
How do they, whatever works. I mean, the ones I've seen have just very much has been on a Excel spreadsheet. Certainly, probably software packages could aid that. Some of the new ones coming out, but certainly it's just, and look, it's probably even the bank managers too, because we do record on a yearly, whenever we do a review of a client, we keep them there, and I actually use it for reporting to our credit department, saying, well, from day dot to now, these guys have grown their assets by X. So certainly the either the information you provide to the bank could be utilised, or just certainly just keeping just your own written, whether it be Excel based or whatever the case may be, keeping your own record of it. But it is a I mean, personally, when I'm commenting on a new to bank deal, or I can physically say, well, these guys started with X and now sitting at Y, and that is a great tick for that person to say they actually are growing assets.
And really, you know, at least the high level stuff will be recorded on your balance sheet, which should be in your software if you are using some accounting software package. Is that right?
Yes, yeah, that should be in there. Yes, yeah, that should all be in there. But again, just be mindful. It could actually be at just a depreciated value, so it
Oh,
may
yeah.
not be of the true value of the business. So that's the only. So I still think it's worthwhile keeping it separate to what is in the software. Sorry, in the accounting side. And the question I got asked quite a lot is, oh, but in the plant and equipment's actually only at depreciated value. How do I put that in? Well, normally would think that the machinery is worth more than what it is depreciated at. So, and look, it's only a guesstimate, but you can have it as long as it's a good educated guess, and you do the same sort of thing year on year. It is always good as a point of differentiating and say, look, this is where we've come from. This is where we think we want to go to.
Great, thank you. No more questions for a moment. So if you've got any final, like if you've got 5 more minutes extra and you want to whiz through the rest of the slides, otherwise we can pull it up there, whatever you'd prefer, Mark.
Well, I mean, probably from what's the slides are left is really the other side of what banks look at. And if you're happy for me to go on, I can. It's just looking at and this is no different to what a bank needs to understand is what a business owner needs to understand is the bank's all about assessing risk, and so should a business operator. We need to look at what things can affect the business, the legal risk, what sort of commercial benefit, the tenure, what the entities, the property being bought in, succession issues, is those sorts of things, deaths, divorces. Cost blowouts in a business, all those sorts of things. How can they be maintained? Because if it's a cost blowout in a business for an acquisition, and all of a sudden well, there is no equity left to do anything, well then that's probably it. That needs to be identified. What happens if that cost blows out? What do we do? So again, it's just all strategies. Next slide. So we'll go over these pretty quickly. So whenever we do is I essentially look at this and go, would I lend this particular entity my money? That's all. I think it's only a reasonable way of doing it. We look at so again, it's the proposal, the structure, soft assessment. So soft assessment is the individual, which the numbers put some rigor around. The numbers that are presented to us in the financial statements actually indicate the soft assessment. And then looking at the risk of the business. Next slide. So when we look at proposals, we look at just the who, what, how, and why. What are they acquiring? How is the asset going to be acquired? And then the last, this is where I start with is what's the end goal? What's the long-term plan of the business? Because then we can see from my point of view, we can see where the business is going to go, or is it just going to be just a one-off? What are they going to do? Next slide. The crucial one, the people, because the people run the business. What's their management ability? How's the business been developed to date? How the decisions made? Who makes the decisions? And I do always ask clients, okay, so this goes, if we're making this acquisition, what's the plan B? Because we really don't want to expose all these assets we've worked for so hard for a new acquisition that's not going to work. And is it, also the other thing is, are they community-minded people, those sorts of things. From a property point of view, it's what are the attributes of the property? Next slide, please. Oh, no, it's gone. Sorry, yeah, so the final, the attributes of the property and what it can be produced. So yeah, from our side, it's just the person the bank lends to is the most important factor. It's just as I said, the numbers provide the comfort to us. Any more questions? I don't think we'll worry about this too much. I think it's unless anyone's got any queries, but um, they're
Maybe,
yeah. I don't think
maybe some of these are questions that people can go and first of all ask themselves and their sort of family and business unit, and then go and have a conversation with your bank manager and the people around you and the local farmers that you really respect, and some of these thoughts might help on the learning journey.
definitely, it's all about learning. It's all about learning.
All right. Well, thank you so much, Mark. We really appreciate your time and insights and expertise. As I said, this recording will be available, and we thank everyone who has logged on live. Thank you for your time. I hope you have taken at least one or two really practical action steps of indicators you want to look further into, or conversations you want to have, or numbers you want to explore further. And thank you again to our partners and to our different stakeholders and community that allows us to run these programs. So happy planning, and yeah, I hope that for those of you starting the summer harvest, that it all goes really well. So thank you and good luck. Thanks again, Mark.
Thanks for having me. Really, really appreciate it.
Lots of thank yous coming through. So people obviously got some value. Thanks, Mark.
Not a drama. Thanks. Sounds good. Thanks, Zoe.